Okay, diversification of a portfolio, investment portfolio. It's one of the most fundamental parts of a mutual fund because you automatically get diversification. So if an investor were just to buy one share of stock or one company, they wouldn't have that opportunity. But with a mutual fund, since it's a pool of investment, they get automatic diversification in different investments. Now, be careful, it will not help against systematic risk. Systematic risk is overall market risk. If the entire market's going down, then the mutual fund will be affected. So diversification will not protect against systematic risk. Let's look at some of the ways diversification can help. We can diversify in particular industry. If we do a specific industry, we're going to have a specialized fund. If 25% or more is in a particular industry, those industry might be pharmaceutical or oil and gas. This would create a greater potential return, but there's more risk involved. A specialized fund is terrible for retired people and often used for people who are willing to take a little bit more risk and have a greater potential return. Types of investment instruments are another way we can diversify. We can diversify through volatilities in the marketplace by having both stocks and bonds in a particular portfolio. We sometimes call that a balanced fund where we have both stocks and bonds. We could have an income fund where we're expecting income. Income could be derived through preferred stock as well as bonds, or common stock in a utility company that pays a good dividend. Or we could do a growth fund. A growth fund is when the company will retain its earnings. So the mutual fund would pick a growth companies where they retain their earning and they're expanding and looking for capital appreciation. Another way to diversify is through a variety of issuers. There's different types of issuers. There could be a large cap company, sometimes called a blue chip stock company. These are large, well-established companies, and they often pay a good dividend as well as they have growth potential. So large, very established companies would be considered large capitalization. They have a lot of money, they're very well known. Then we have a mid-cap company. Mid-cap companies are kind of the middle of the road. They likely will pay a dividend. They're still retaining some of their earning. They're still expanding. They're a little bit in a growth phase, but not too much. They've sort of gotten established. Small cap companies, that's where you're going to see your biggest growth potential. Small cap companies are smaller companies that are trying to expand, so often will retain their earnings and have a greater growth potential. So when we're looking at diversification, we could have a mutual fund that invests in large cap companies, also known as blue chip stocks, or a mid-cap company going through companies that are pretty well established. They might be regionally based versus a small cap company. Small capitalization companies usually retain their earning and are still in a growth phase.